Okay, now we'll look at some of the ways to evaluate these organizations or segments of organizations, and I'm just going to review it, and remember that we'll do a lot of problems in class on this, and the problems will really help clarify what's really happening with these. So when you think about an investment center manager, they're really considered like separate businesses in many ways. All right, they've got complete control over their assets and their revenue and their profit centers. Okay, so two common performance measures are return on investment. So return, whenever you see the words return on, that's net income, and investment is assets. And then another measure called residual income. And the residual income is how much the company earned above what they were expected to earn. And it's a little bit different than what you think it might be, but we'll work problems on these for sure, and you want to make sure that we get this clear in class, that you're clear on it anyway. And here's an example of an organization-wide performance report, and you want to read this sort of from the bottom up. This is Tropicana, is part of North American Beverage, which is part of Pepsi. Okay, so Pepsi is the big multinational. That's the big company, and these are divisions that are within each other. And you can see the format here is a contribution format. So we've got sales revenue less variable expenses is contribution margin, less direct fixed is a segment margin. The segment margin minus allocated common expenses gives us operating income. So once Tropicana had theirs completed, then it rolls up into North American Beverages. All right, and Tropicana is one company, well, not company, but one division that's their operating income, and that's within the North American Beverages segment. Okay. Now this total North American Beverages rolls up into Pepsi, where North American Beverages joins Frito-Lay, Quaker Foods, Latin America Foods, etc. Okay. And then the other thing here, notice that there's corporate costs that are unallocated. So there are some costs that weren't allocated out to the other divisions. All right, but the thing to remember about the unallocated costs is that they're not controllable, and they're really somebody else's problem at a high level. Now, return on investment. Remember, return on is net income, investment are assets. So it measures the amount of income an investment center earns relative to how big its assets are. Okay, like if you had, let's think about it. Just think you had $100,000 in the bank and you expect it to earn maybe 7%. Okay, that's how much you expect the return on your investment to be. Okay, like $7,000. So here's the return on investment is operating income divided by total assets. Okay, and the higher the ROI, the return on investment, the better. And remember that this is one way of doing it. You'll see companies, basically it's going to be some kind of income divided by total assets. Total assets can be calculated in different ways. They might take operating income plus or minus different numbers, but don't let that bother you. Okay, the basic concept is the same. So here's this is divisional data for PepsiCo America's Beverages. Say the beverage versus the snack divisions. Okay, and they've given us operating income, assets, and sales revenue. So your return on investment, return on will be operating income, right, divided by assets. Okay, so the snack division's ROI is 9.9%. Or beverage division is 9.9%. Snack division, good grief, 4304 divided by 8375. 80% is the snack division. I'm amazed at this. I don't know what other costs are in here. I would have expected the beverage to be higher than the snack, but it is not. Maybe it's the, oh, you know what would make a big difference in a beverage division? You've got a big investment in plant because you've got bottling companies and all that stuff, so your assets are high. Okay. Now here's sales margin and capital turnover. So if I take return on investment, it's called the DuPont formula. It can be taken apart into operating income divided by sales, which is your sales margin. So think about that just for a second. So operating income on the income statement divided by your sales. That's for every dollar of income we have. How much came from sales? There was sales margin. How much we're earning on sales. That's what it tells us. And then if I take sales and divide it by total assets, that's how much, that tells us capital turnover. In other words, that's how many times our capital is creating sales. All right. And if I take my sales margin and multiply it times capital turnover, that gives me return on investment. And what the ROI formula is it basically, I hate it when people say that, but what it does is it crosses out, it cancels the sales. Okay, so what we're left with is operating income divided by total assets. Okay, and here's a sales margin example. It focuses on profitability. And think about that. Sales is on the income statement, so we're talking about profit. Focuses on profitability by showing how much operating income the division earns for every dollar of sales revenue. Okay, so for every dollar of sales revenue, how much ends up in operating income? So for the beverage division, their operating income is $27.85 divided by sales of 13.5%. So that's 13.5 cents of every dollar of every dollar sold ends up in operating income. Okay, and then in the snack division, this still amazes me. Snack division, our operating income is $43.04. Divide that by sales, 14 bazillion, whatever it is, gives us 29.1 cents. So for every dollar of income, 29 cents ends up for every dollar of sales, 29 cents ends up in operating income. So that's pretty interesting. Think about that the next time you buy a little 4 potato chips in a bag for $2. Okay, now capital turnover. This focuses on how efficiently the division uses its assets to generate sales revenue. Okay, how efficiently the division uses its assets to generate sales revenue. So capital turnover is sales divided by total assets. Okay, capital turnover, sales divided by total assets. So in the beverage division, my sales are $26.18 divided by the big total asset number of $28,128. That's 0.73. Okay, and this is not a number that you can just evaluate by itself. You have to compare it to other divisions or to similar divisions, or other, say segments in the same industry. So the snack division has $14,782 in sales divided by a lower asset number, so they're definitely use their assets more efficiently. Okay, 2.75. But if you think about it, would you expect the steel industry to have high or low capital turnover? Okay, you've got a big bunch of assets there, right? Great big fixed assets. So that turnover would probably be kind of low. That's what you'd think. Like there's a big investment required to even get into the business. Okay, but you look at some service industries, it's completely different. Okay, because your asset number would be low. Or any technology industries probably have low asset numbers. Okay, but some of their operating expenses would be very high. Okay, but you want to compare it to other companies though to make it meaningful. Okay, now residual income, and this is one, when we do these problems, make sure you're really focus on what I'm saying because there's one tricky part in here. So determines whether the division has created any excess income or residual income. Residual would be like leftover income above and beyond management's expectations. So there's a new expression that comes up here called a minimum acceptable income. Okay, the minimum acceptable frequently is stated by the shareholders. They want 10% on the assets. Okay, so the minimum acceptable income is 10% maybe times an asset balance. So if I take operating income minus this minimum acceptable income, okay, target rate of return times the assets, that gives me my residual income. So for the beverage division, their operating income is $27.85, and let's say the shareholders or management have a target rate of return of 25% times total assets. There's that big 28,128. Okay, the Murphy's Law. We've got that big asset number, so they want 4247. All right. Target rate of return times total assets. So operating income minus target rate of return times total assets gives us our residual income. In this case, it's negative. Okay, they're not making it. The snack division is 4304. Target rate of return is 25% times what's invested in it so they've got residual income of 2960. It's very positive. Okay, so that's why companies really think twice about adding to their total asset balance, because it affects evaluations like this. I mean, their bonus for the year may be tied to this number, to residual income. Okay. And when we do the problems, it'll get much clearer, but make sure that you, if I can find them, you print the problems out ahead of time, and then we'll work on them together in class. Okay? And these are the performance measures that we looked at for an investment center so far. We've got return on investment, operating income divided by total assets. Okay? Sales margin, operating income divided by sales. Okay? Capital turnover, sales divided by total assets. Sales divided by total assets, yeah. And residual income, that's operating income minus the target rate of return times total assets. Okay, and I'll tell you, the thing you've got to watch out for this is how this is expressed, so that when you see it in a problem, you know what you're looking at. All right, you need to know these values. There won't be, you can't have any sheet like with these formulas on it. You'll have to know them. And for what it's worth, I teach in the MBA, and we've got 5 live companies that we evaluate, and we use these formulas all the time. Okay, you can see what the effect of an action plan is. You can compare your company. You can benchmark it against other companies. You can see if you're better or worse after like some kind of planned improvement you're making. Okay, so this was kind of long, sorry. Next time we'll look more at goal congruence, okay, and what that means.